Welcome to the Preparing 2025 Taxes as a Worker-Owned Co-op webinar. I am Maureen Darris. I work in the Co-op Clinic. I appreciate all the USFWC staff that have shown up to support me today. This webinar is for a variety of entity types. So if you're not sure if you're in the right place, our presenter today, Andrea Roldan, will be doing an overview of multiple types of legal entities that your co-op could be incorporated as and the corresponding forms. And the reason we put on this webinar is because the USFWC is the national grassroots membership organization for worker cooperatives and democratic workplaces. And we know there's a variety of entity types among our membership. And as our mission is to build a thriving ecosystem for worker-owned businesses, to power movements for racial justice and economic democracy, we provide free education and training to make sure that your co-ops have access to the information you need. And if you're a developer, that you're informed about what services and technical assistance to provide in your community. I mentioned the Co-op Clinic. That is our education and training team for worker-owned businesses. We provide culturally affirming services through a network of peer advisors. Our peer advisors are worker owners who have years, if not decades, of experience working in worker-owned businesses and consulting from a peer-to-peer level to provide information and resources and best practices from their own lived experience and from the experiences they've witnessed by providing technical assistance and training to other co-ops. If you're a USFWC member, you can receive regular support from our staff and reduced rates for technical assistance and training if you wanted to work with a peer advisor. And we have regular technical assistance and training workshops and events, including this year will be the Worker Co-op Conference, and members receive discounted access to our conference. So for those of you who are members, thank you for building this movement and leading it. And for those who are not members, there's information about how to become members on our website. I also wanted to thank one more group of people, which is the National Cooperative Bank. They're our sponsors of our webinar series this year. They provide banking products and services to cooperatives, their members, and socially responsible organizations across the country. I've also seen them at co-op events I go to all over the country. I've heard great things from our clients who bank with them. And if you're looking for a solution for where to store your finances in the co-op movement, we recommend NCB. And with that, I'm going to pass it to another ally of cooperatives, today's presenter, Andrea Roldan, who's been doing this webinar for years and every year brings fresh content and a really warm presence to the co-op conversation about taxes that might have some people stressed out. So thank you for the way you make taxes and all of this accounting information accessible to our movement, Andrea.
Yes, thank you, Maureen. And I want to thank everybody for being here today to learn about some of the stuff that can be very challenging. My hope today is to make it less challenging and provide helpful information so you guys are prepared for tax season. So my name is Andrea Roldan. I am a partner at the ARCPA group, and we have been working with cooperatives extensively, all types of cooperatives for a number of years. And so we're presenting this information today to talk about all of the different types of cooperatives that you can use to file your taxes and run your business. And so we'll switch over to the next slide. Yep. So what we're going to start with on our agenda today is we're going to provide you some key definitions that will be helpful in understanding the webinar and knowing the key terms to run your business. We want to ask that if you have questions, you can place your questions into the chat. And we have a few times in the presentation where we're going to stop and we're going to answer those questions. So if you can just type them into the chat, we will respond to them when we get to that section. And we're going to go over a couple different types of entities today. And the information is organized in a way where we're presenting it distinguished for each entity. So just pay attention as we present the information. If what we are discussing applies to your entity type, each slide will identify which entity we're referring to. So it's very important to make sure that you receive the information that applies to your entity type. So with that, we will advance to the next slide. And with these definitions, they're on the screen. Feel free to read them. We're also going to drop them into the chat so that you can read them as we continue the presentation. Just to clarify one of the definitions verbally, because this is one that we are going to use quite a bit. Patronage allocation. I just want to be very clear when we refer to patronage allocations in this webinar that we are referring to the allocation of profits from the company. So the allocation of profit based on contributions to the company that helped derive that profit. So it's returning the profit to the members or to the worker owners in proportion to their contribution. And the rest of the definitions you can actually find in the chat. So we'll start with, before we go into the distinguished information for each entity type, we'll start with what a year of business looks like for each company. And so no matter which entity type you choose, whether you're a partnership, a subchapter T cooperative, or a S Corp, every business functions primarily the same way, that we start the business or we're going into a new year of business. If we've already been in existence, we have a full year of activity. So that's our business activity. We have all of our inflows coming in from the sales of products or the sales of services. We have our expenses going out, potentially to accountants, to lawyers, to software, cost of goods sold, things that we buy, equipment that we purchase. We have a full year of activity, and that we hope while this is all happening, we are monitoring our progress. We're monitoring our activities through our financial statements, right? So we have our bookkeeping being completed throughout the year, monthly or quarterly. We're looking at our reports. We have a good idea of where we stand, where our revenue is in comparison to our expenses, compare our progress to our budget and our goals for the year by using our financials, right? Interpreting our financial statements. And so after those two things happen, we approach the end of the year and going into the next year after we complete a business cycle, and we are required to file tax forms, right? So we file our income tax forms, which we're going to talk in detail about during this webinar. But we also file other tax forms like W-2s, 1099s, any other grant reporting, potentially other compliance related forms. And we're not going to go over the payroll deadlines in detail, but I will say that because we're in the month of January, January 31st, you can use as a blanket deadline to file and send out your W-2s, your 1099s that you paid to contractors or service providers in your business. That deadline to file and send those reports is at the end of January. And that is not the same. The 1099s and the W-2s are not the same as how we're going to report payments to partners. So we'll talk about that. But for everyone else, if you have W-2s, 1099s, those would be filed by the end of this month in order to not be late. So we're going to segue into talking about income tax forms that we file after we get our payroll forms out of the way. We're going to start with the first form that we're going to start with is the 1065. So the form 1065 is the tax form that a business will use when they have organized with the state, the Secretary of State, as either an LLC, which is most common these days, or as a partnership. The Form 1065 is a partnership tax form. The deadline to file this form, the initial deadline, if you have all of your reporting, you have your income statement, you have your balance sheet, and you're ready to file, the deadline is by March 15th. If you find that you still need time to clean up your books and you still need time to update your book, update your reports and finalize the information so that it's accurate for everybody, you can file an extension with the IRS, and that will give you an additional 6 months. So you'll have from March 15th to September 15th to file what they call the finalized version of the return, the extended version of the return. So what's unique about the 1065 is it's a tax form that represents the consolidated ownership of all of the members or all of the LLC worker owners and owners in the company. And so the 1065 is where everything is consolidated. And the K1s that are generated after the 1065 is complete goes out to each individual and each owner and allocates the amounts of the total that are applicable for each person. And so with the 1065, that means profit is allocated if you have a profit. Losses are allocated if you have a loss. The 1065 and the K1 take all of the information for the partnership business and it passes it through to the owners. So the partnership itself doesn't pay taxes, but the K1 carries the information that the owners will use to pay their own taxes on their individual return. And on that K1, I mentioned earlier that members of a partnership or worker owners in an LLC, that they don't get their payments reported on a 1099. So if you look at the K1, you guys can access the resources here, the documents here, and click the hyperlinks. If you look at the K1, I think it's box 4 on the K1, there's a section called guaranteed payments. That section is where the owners of the firm will report the payments that they receive from the business to themselves. So that's different from sending a 1099 to a lawyer or an accountant or a marketing advisor. You report payments to the individual on the K1. And so all of the activity on the 1065, the partnership, the LLC, is reported on the K1s and then taxed and finalized on the individual tax return. And so the next entity type that we're going to discuss, and we will have a section for questions about all of these forms after we finish going over them all. So if you have any questions, just drop them in the chat and we have a section for questions after this. And so another entity type that you may be filing under if you're a worker cooperative, if you're a cooperative business, is as an S Corp. So you wouldn't be an S Corp unless you specifically have asked the IRS to allow you to be taxed as an S Corp. So if you're an S Corp, you will know it, right? It's not a mistake that you would find yourself being taxed as an S Corp. So similar to the partnership deadline, S corporations have an original deadline of March 15th. If you file the extension, if you need more time, especially to find deductions and lower your tax bill, if you extend it, the extended deadline is September 15th. And the S Corp is very similar to the partnership in that all of the activity flows through to the owners. So the S Corp itself doesn't pay taxes, but all of the activity, all of the income, all of the losses, all of the interest, whatever you see on that S Corp return is reported to the owners on a K1 that's specific to S Corp. So if you're doing your taxes yourself or if you're using paper forms, make sure that you choose the K1 that is particular to either a partnership or an S Corp because they are different. So all of the activity of the S Corp is reported out to the owners, and then the owners finalize and pay taxes on their share of the amounts of the S Corp activity. Now, the difference between the partnership and the S Corp is that there are limitations on who can join an S Corp and how large an S Corp can be. So one of those is that the S Corp is limited to 100 owners. And there are some particular rules around who's considered an owner and whether a husband and wife can be grouped, but you can look into those rules offline. And there's also a rule that you can only have one class of stock in an S Corp. So S Corps are not commonly used for worker cooperatives because some worker cooperatives have more than one class of stock or membership stock. But if you use an S Corp to run your business, this is the information that will be helpful for you in filing that S Corp return. And then the next slide that we're going to go over, the next slide we'll go over are the nonprofit 990 tax returns. And these tax returns aren't necessarily for worker cooperatives. It's not common to have a nonprofit that's a worker cooperative, but we wanted to include it because some organizations have sister organizations or they have affiliates where they may use a nonprofit if they're affiliated with a nonprofit. You may even serve on the board of a nonprofit. And so if you find yourself in that situation, just know that for the nonprofit income tax returns, those are originally due not March 15th, like we've talked about with the other entities, but May 15th. So May 15th is the original deadline to file a nonprofit tax return. And if you extend the deadline, because you can extend them for all entity types, then your deadline would then become November 15th. So that would give you 6 more months to file. And with most nonprofits, the nonprofit itself does not pay taxes. If it's a charitable nonprofit, if it has an exemption from the IRS under certain statutes and the way that they operate and the goals of the nonprofit have to qualify. So it's not necessarily about filing and showing the profit or the losses, but the nonprofit return focuses more on operations and transparency. So that return is focused heavily on reporting who's involved, who gets paid, how much the company brought in, who provided significant support for the nonprofit, and how the support that was received was used, how it was spent and how it was used. And so at the top of the screen, you'll see it says Form 990/EZ/N. The reason we have those different alternatives there is there are actually 3 versions of the 990 return. There's the full 990, which is the most complex filing. It's the most complex version of the form. And that applies if the gross revenue of the nonprofit is above, I think it's 250,000. It's above a certain number that the IRS establishes. I think it's 250,000, then you would file the full 990. If you make less than that amount, you have the option to file the 990EZ, which is a shorter version of the return. It's a little bit easier to fill out. It's less complex. And if you make less than 50,000, the company brings in less than 50,000 of gross revenue, you actually file what's called a 990N. They call it a digital postcard because it's the least complex. It's the most simple version of filing that form, and you can do it online. It's not a lot of informational reporting. It's more just simple transparency, and you can look up with what all of those forms look like there. And so the next slide we want to talk about is going to be actually one of the more complex versions of the form that we're going to be filing is the 1120C. And this is the form that we'll file if you are organized with the Secretary of State as a limited cooperative association, as a cooperative, no matter what it's called in your state. It can be an employee cooperative, a worker cooperative, or if you were organized as an LLC in your state, but you filed the form to choose to be taxed like a subchapter T cooperative. So this section applies to you if any of those entity types are applicable. And what this income tax form is the tax reporting for a corporation that operates on a cooperative basis. The original deadline for this one, if we don't extend it and you're ready to file, would be April 15th. If we need to extend, we file the extension and we get the 6-month extension approved, then you would file the finalized version October 15th. So what's tricky about this form is that there's no electronic filing option available at the moment. All of the 1120Cs must be paper filed. And with the 1120C, you don't flow through the information to the owners automatically the way that you do with the partnership and the S Corp. The 1120C return is a standalone corporate return where you may end up paying taxes if you're organized as an 1120 as a cooperative. You may pay taxes at the corporate level on any amounts that are not distributed to owners as patronage. And again, patronage is the allocation of profit based on contribution and value provided to the company. So if we have the 1120C, we have all of our income and all of our expenses. Whatever profit remains, if we allocate that profit to the owners, which means push it through to the owners onto the individual taxes, the 1120C or the cooperative can reduce the taxable income to the corporation by that amount. And the owners pay the tax on what was allocated to them. And that's one way to reduce the taxable income, potentially down as low as zero. But if you have amounts that you don't allocate to owners, if you choose not to allocate it, or if you have amounts that don't qualify to be allocated, the 1120C is where you calculate what your tax rate would be, what your tax bill would be. So we have a couple slides that discuss the 1120C, and this slide is specifically for, we'll use this slide to cover all scenarios of 1120Cs. If that's the form you filed, this would be your deadline, and these would be your, this would be information that's applicable to you. But we're going to go to the next slide and discuss an alternative deadline that applies to cooperatives if certain conditions are met. So if you are filing as a cooperative and you meet these certain conditions that are established by the IRS, then your original deadline is not actually April 15th. The original deadline would be September 15th, and you can still do a 6-month extension. So it could get crazy if we extend from September for another 6 months, because then we'll be into the following year in March if we do an extension after that. And so you may ask, well, what are the requirements to get this extended deadline? And those requirements are, this is only allowed for certain types of entities, certain types of businesses. And so you cannot use this extended deadline if you are a mutual savings bank, an insurance company, or a utility company serving rural areas. I don't think that those 3 types are going to affect a lot of our viewers today, but just know that there are some exclusions on the type of entity you are. And then the second obligation, if you qualify and you're not one of those types of entities, then the second obligation is that once you calculate your profit, if you know what the profit is of the company, if you plan to distribute more than 50% of the profit to the owners in the form of patronage, then you have access to this extended deadline. And the reason that you get this extended deadline is so that you have time to not only wrap up your books, prepare the tax form, but then also calculate and measure how that patronage is to be divided among the members or the owners, because remember, the patronage is the allocation of profit based on the value that is contributed or provided to the company. So if you're allocating more than 50% of your profit to owners in the form of patronage, which means, we may have to figure out calculations to determine how much people contributed, how much value was provided in order to share profits pro rata. That's one requirement. And then you have to be operating on a cooperative basis. The general understanding in most cooperative communities for a cooperative basis is democratic decision making. And the other option to get this extended deadline is if you have already paid patronage in the prior year, you get the extended deadline so that you can finalize reconciling patronage, reporting the patronage, and then giving the members the chance to respond to their patronage allocation. So you do have the option for an extended deadline if it applies to you. For most cooperatives, it may apply as long as you have profit and you are allocating the profit to your members. I think we have one more slide on this one. Yep, so then this one just discusses an example we wanted to share with you guys. Most of the deadlines that we've provided so far are provided with the assumption that your year ends December 31st, right? So if your year ends December 31st, the deadlines that we've showed you, the dates and deadlines are applicable. But we wanted to provide information in the event that you don't have a year end that is December 1st, you're not on a calendar year, you have a fiscal year. So in our example at the bottom of this page, instead of the September 15th deadline, if you ended on December 31st, let's say, for example, that your year ended on May 31st of last year, for instance. If we were to apply the deadline based on the number of months that you're allowed to prepare the return with this extended deadline, then the initial deadline for a company whose fiscal year ends in May would be February 15th of the following year. And if you file an extension, you would get 6 months past that original deadline, which would be August 15th past of the following year as well. So it'd be 6 months after the first deadline. In this case, from February to August with the extension. And the same example can be applied to the prior dates that we gave for any entity type. If you're on a fiscal year, you would just add the number of months and days to when the end of your year is. And then was that the only example slide? I think so. Yep. So then this form, I mentioned earlier that if you are an LLC or a partnership or some other entity type that has elected to be taxed like a subchapter T cooperative, this form 8832 in this slide is to explain what that means. So if you organize with the Secretary of State as an LLC, because that is usually the easiest way to organize and get started with your business, you can file this form 8832 with the IRS to ask the IRS to recognize you and tax you like a subchapter T cooperative or just like a corporation, even if you're not a cooperative. You can file this form and ask the IRS to tax you differently than your default classification. For most LLCs, the default classification is as a partnership. That's how you would be taxed. But if you file this form, you can ask the IRS to say, hey, don't tax me like a partnership, tax me like a corporation or like a cooperative corporation, or there's a different form for S Corps, but you can ask to be taxed differently than how you're organized. So the next slide, we just have a stopping point for questions. I know that was a lot of information. So I see the chat has a number of responses. So if we want to go through those, we can.
Sure, and I invite everyone who needs a glass of water or to take a deep breath to do so now. Thank you, Andrea, for speaking slowly for the interpretation team. I have two questions from the chat, which I'll read out loud so they can be interpreted into Spanish. One from Matt Jones, who says, our co-op was formed January 27th, 2025. Would this be considered a full calendar year?
So the question is, if an entity is formed January 27th, would it be a full calendar year? The answer would be no, that it's not a full calendar year. But if this is your first tax year that you formed your entity, your default year would still end December 31st. So just because you started the business January 27th, it does not automatically create a fiscal year for you. Every business that starts is presumed to end on December 31st. There's a different form you can file. We didn't include it here, but there's a different form you can file if you want to change your year end with intentionally to change your year end. But what that means is if you started January 27th, you would file your first year, and there's a box on the return that you mark letting the IRS know that it's your first year. So it may not, the amounts that you're reporting may not represent a full 365 or a full year. But after that first year, after you mark initial on that first return, every year after you'll be filing a full return, a full year return that ends in December, unless you change your year end. So you can change it, but it's not automatic just because you started in January, some other day of the year. Does that answer the question?
Yes, Matt said thank you in the chat. And thank you, Matt, for asking, because I see you're not the only one who had that question. The next question, forgive me if I'm mispronouncing this, because I think your name might be French and I don't speak French. Is it Shamey? Who asked, are C corporations choosing to operate as worker-owned cooperatives? Again, that's C corporations choosing to operate as worker-owned cooperatives handled differently from S corps.
Yes, that are C corporations choosing to operate is handled differently from S corps. So the question is, it sounds like, correct me if I'm wrong, the question is, are C corporations operating on a cooperative basis treated differently than S corps? And the answer there would be yes. A C corporation is the default type of entity for any companies that file an 1120 tax return. An 1120C, which is what most cooperatives use, is a cooperative corporation. And when we refer to cooperatives or subchapter T company, these are corporations who are operating on a cooperative basis, and they file the 1120C, Maureen, if you want to go back to that slide, the 1120Cs. Those are different than S corps. And that's why I said earlier that you won't mistake yourself for an S corp. I think it's the first one, slide 15. Yeah. So the 1120C is for the cooperative corporations. If you are filing as a cooperative corporation, you've either organized in your state as a limited cooperative association or some cooperative statute that's available within your state, or you've organized as an LLC and you've made the election to be taxed like a corporation, or you formed as a corporation and you operate on a cooperative basis. Either of those three things are distinctly different from an S corp. which an S corp you could an S corp can be any type of entity. You can be an LLC and file as an S corp, and you can have organized in the state as a corporation. But to be taxed as an S corp, you have to file. We didn't put the form here, but you have to file. I think it's a 2553. It's a different form to ask the IRS to recognize you as an S corp. So that's why I mentioned earlier, and I'll say it again, you will not find yourself filing an S corp return on accident. You have to um, request from the IRS that they allow you, slide 13, Maureen. You have to request from the IRS to be allowed to file as an S corp return. There's an application you have to do in order to file that way. Does that answer your question?
Yes, what it was put in the chat was, okay, great, thank you. We are
Okay,
not an S
awesome.
corp. We formed as a C corporation, operating as a cooperative. So we fall under the types of orgs that file Form 1120C.
Yes, that sounds correct. And yeah, that sounds correct. And then 1120C, I believe, yeah, it would be calendar year. So just refer to the slides. This slide, is this 15? Slide 15 covers all cooperatives that the deadline would be April or October, unless you meet the requirements of slides 16 and 17, where your deadline would be extended if you are allocating patronage. So that means you would need to be profitable that year. So if you don't have a taxable profit, then you're probably not going to have a September 15th deadline. But if you're profitable and you're allocating patronage to worker owners or members, then your deadline is pushed to September 15th. I know we covered a lot of information in that section. So does anybody else have other questions? Because we do have some time. And I
There are
can
two
go
more
over, is there any
questions.
parts that people want me to go over again?
One question from Rolena is, if we were set up as a cooperative corporation, we would be taxed as such, correct? We would not need to file Form 8832?
Can I clarify there when they say we were set up as a cooperative corporation? Can you give me more specifics? Are you sure are you saying that you were set up as an LCA in your state?
Rolena, if you're out there, you're welcome to answer by coming off mute.
Or did you form as a
Yeah.
corporation with stock?
What I have in front of me says that we are incorporated as a New York Worker Cooperative Corporation.
Okay. I'd have to look up the specifics for New York State, but the way that I want to answer that question is one, it may depend on the state because every state's statutes that allow you to form a business using a certain type are written individually. So it may depend on the state. Um, but what I would suggest, a lot of states, they allow you to form as an LCA, which is a limited cooperative association. And even if you form under the LCA, depending on the state, we still recommend you file the 8832 because some states recognize the association, the limited cooperative association, as a partnership filing or as a flow through filing. But it does depend on the state. I would say that's the best answer for that question. If you're in New York, I would read the statutes that govern the way that you guys organized because that will, the statutes themselves are the laws that say what type of business you can form, what tax rules apply to each type of business. And so I can look into that for you after the webinar just to make sure. Oh, somebody dropped that. Okay, yeah, Maureen dropped a link in the chat. Let me see if this is easy to quickly read. Oh, yeah, so this one says cooperative corporations. for New York. So if it says cooperative corporation in the statute, I would assume that you don't have to file the 8832 because they recognize the company as a corporation. Not all states recognize LCAs as corporations, but just briefly, what I'm seeing here, if this is the statute, I would say no in this case because it's already recognized as a corporation.
It looks like that makes sense. And Rolanda says, thank you so much. And next on stack is an iPhone, who asked, we have our co-op set up as an LLC partnership, but only 2 of the 7 owners are listed as the owners. The other 5 workers are not listed on the incorporation paperwork. Should we file 1099 or K1s for those 5 workers?
So this is an LLC partnership. Is it 7 workers, 2 are owners, and the other 5 are not? Okay. Is the intention with the other 5 workers to become owners? Are they candidate members? Are they provisional members?
iPhone, if you're out there.
Sorry, I was trying to find my mute button. Thank you. Hi, yes. So they are they're worker owners. It's just that the structure is set up as an LLC.
Okay. And when you say that they're worker owners and they're not, I forgot the wording you used, but
Their names
maybe
are
they're
not
not.
in the incorporation paperwork.
Oh, yeah. Okay. So that's fine because we expect a business, once it's incorporated, the owners may change, right? So the incorporation paperwork is starting the business, and it's very common for ownership to change after the business is started. So there's 2 things that I would refer to in how to handle the situation. The first one are the bylaws. So if the bylaws identify candidate members and full members, and these 5 worker owners have met the requirements according to the bylaws to be considered a member with a share of ownership and a share of profit, you can report them as owners when you file the tax return because the bylaws are, I'm assuming, in accordance with state rules about ownership. If they've met those requirements and they are considered owners, then and they share in the profit, then you can report it that way on the income taxes. So to the question of 1099 or K1, that would be on a K1. But the next component I would make sure to look out for is when you filed your organizational paperwork, every year or every other year in some states, you're required to file annual reports or biannual updates. That's where you'll add in those annual reports any ownership changes. So that's what the annual reports are for. Some states do it every other year or every 3rd year. So that's where you can report. They may not be on the original incorporation paperwork, but eventually you do want to add them to the annual report with the Secretary of State if it asks who the owners are as you file your annual report. Does that answer your question?
Yes, thank you so much.
Okay, awesome.
There are 2 more questions that I'm aware of in the stack,
Okay.
and then I'll see if any other questions come up, and if not, reminding everyone that we'll do a second part of the presentation and then reopen for questions. So if it takes you a while to gather your thoughts, there'll be another round, and this is a real spoiler, but at the end of the presentation, we're sharing how to have a free consultation with Andrea, so there'll be more opportunities after that. So the next
But the
question,
questions are good though. We're doing great answering and clarifying. So keep them coming.
this one is from Oya. This year, we used a business LLC in Georgia and have not yet incorporated as a co-op. Would the tax filings you described apply to us in this case?
Yeah. So the question was, it said this year, but I'm assuming it's for 2025 potentially. If it was for 2025, when you say you started as an LLC, I think is what I heard. You started as an LLC, you haven't incorporated. I forget the language, but started an LLC, haven't elected to be treated as a corporation. The answer to that question for this person and anyone else who started businesses recently, whichever year you file with the Secretary of State, even if it's on December 31st of 2025, whatever year you do that, you are creating a tax liability. Filing for an LLC or a corporation or any entity type with the state is like giving birth to your business baby, right? So once you do that, the tax return is like your annual birthday. So anytime you file with the state to start a business, even if it was December 31st of 2025, you have to file a return for that one day. So in this case, the question that was asked is we formed as an LLC. We haven't yet switched over to cooperative or elected to be taxed as a cooperative. Then what that would mean for your current income tax filing for 2025 is you would file as a partnership because that's your default classification as a partnership. But remember with Form 8832, you can file that form within the first, if you go back to that slide, Maureen, it should be like 15, yeah, 18. You can file that form within the first couple months of the following year. So if we're referring to 25, you organize as an LLC, and it's your intention to be taxed and operate like a subchapter T cooperative or a cooperative corporation. You can file this form. And there's questions on the form, and there's a part where you can respond on there to describe the circumstances. As long as you file the 8832 before your tax return and before the original deadline for the tax return, so either March or April, you can still change how you're taxed before you file that 2025 return. So by default, from what I'm hearing, it sounds like you would be taxed as a partnership if you don't file the form immediately, but you still have time to file the form if you intend to be taxed as a cooperative corporation. You can file it within the first 3 months or 75 days of 2026, and then that will apply for 2025 so that instead of filing a partnership return, you would just file the 1120C if that's what you intend to do.
Did that answer your question? Yes, we got a thank you in the chat. Cool. There's one more pancake I know of in the stack of questions, which is from Mary Claire Calma. How, if they are probationary members, will we need to issue the Schedule K1 tax?
Yeah. So the question is if we have members who are probationary, not yet considered full members, how will you issue the K1 to them or report payments to them? And unless the bylaws say differently, I would first refer you to your bylaws about what the bylaws say within your organization. But the default answer, unless the bylaws say differently, is you don't issue them a K1. They would receive, if you have probationary members who are not yet members with full rights of ownership and full rights of profit share, then they wouldn't receive a K1. They would receive a 1099 NEC, which is a payroll form that's due at the end of January. They can be filed electronically. They can be filed on paper manually with the IRS. If you download, you have to order, it's a specific type of paper if you're doing it manually. But you would send those 1099s on behalf of those probationary members if they're not full-fledged members. So they would not actually get K1s. If they don't have a share of ownership, they may still take part, depending on what the bylaws say. They may still take part in profit share, but you would still report their share of profit on the 1099, not the K1. Is that helpful?
Thank you. Thank you very much.
Okay, awesome. Is that all the questions? Did we clear the? Okay. All right. Well, it seems like we're ready to move into the second part of the presentation today. And we're going to talk specifically about one of the core pieces of the worker cooperative, the subchapter T cooperative, and what we've been referring to as patronage, right? Patronage allocations. That's your question may be, well, what is it outside of the definition, which is the allocation of profit based on value contributed or value provided? If we go to the next slide, one of the key requirements here when we're thinking about patronage is value provided or contributed to the company, right? Because instead of allocating profit equally or according to how much, not equally, but according to how much money was contributed or how much capital was provided, we're going to divide our profit based on how much effort, how much value, how much input each member had. And there's a couple different ways to do that. We have a few examples for you that we're going to go through. There's three of them. So this first one, if we decide, I know it looks like we're
Sorry,
having
I'm having a tech issue, so
okay,
I'm just gonna reshare my screen. I'm sorry.
okay,
Um,
that's fine.
Oop. Thank you for your patience.
I could just keep talking about patronage, but I feel like it may be easier with the screen now.
Yeah, don't send a big blind.
Okay, can everybody see the screen now? We're back to, okay, we're getting some thumbs up. If anybody has trouble from here, like seeing the screen, just drop it in the chat and we'll try and get you some help. But it seems like we're good again. So we're talking about patronage allocations, right? For a worker cooperative, whether it's a partnership or subchapter T. This applies to anybody who is, these sections apply to anybody who is allocating profit according to one of these three methods, right? So we could say that if we have profit, one way to do it is to divide it equally, right? A lot of companies might choose this route just to keep things fair, to keep things even. If we decide that, every person's contribution is equal, then each person, if we have a profit of say $5,000, is allocated the same amount. In a four-person partnership or cooperative, that would come to 25%. So you take the 25% and you would multiply it by the total. What's the total profit? That gets allocated to each person. If you're a partnership, that's the amount that goes on the K1. If you're a subchapter T cooperative, that's the amount that's reported to you on your patronage dividend. And there's one way to do it is to do it equally. If we go to the next slide, well, these get more complicated as we go, so just be warned. The next slide, we'll talk about, we mentioned a lot allocating patronage on the basis of value contributed, right? So for a lot of worker cooperatives, what we use to measure value contributed is hours worked. So in this example, instead of just taking 25% equal allocation to each member, we have to add up all of the hours worked by the members, assuming that there are four members. In our example here, we take four members, we add up all of their hours, and each person has a share of those total hours. So their profit, their share of profit is in proportion to their share of total hours worked, right? So if person A worked 125 hours, and 125 is 3% of the total hours worked, then instead of person A getting an equal 25% share, person A is going to get a 3% share of profit. And so on for each person. Their share of profit is proportional to the hours, the proportion of hours that they worked. Yeah, we have another slide that talks about other ways to measure patronage, and you'll see here with this next slide why the IRS gives you until September. They give you that extended deadline to figure out what the patronage allocation is. We took out the third example where we had a bunch of calculations on different ways to allocate patronage. What we decided to do was simplify the concept instead of the complex example and just remind you guys that if patronage is based on value provided, then we encourage you to think about and really consider how you measure value within a company, right? So our prior example focused on hours worked. And that's pretty straightforward. Everybody can track and measure how many hours they work, but it may get more complicated than that if you find that hours worked doesn't serve your company well. For example, if you are a legal cooperative or an accounting cooperative or any business type where efficiency is a priority, you may find that allocating profit based on number of hours worked may not be sufficient. So, if somebody's inefficient, if somebody's inexperienced, somebody is, just not being productive, like efficient, then they may end up working more hours than people who are more experienced or more efficient or maybe hold a different role within the company. And so we encourage people to think instead of just hours worked, to think about how you measure value provided to the company. That could be by hours worked if that works well for rewarding people. Remember, profit is the reward for the work that you do. If hours worked is a good way to reward people for what they contribute, great. If you find that it's not sufficient, consider other measures. And some of those other measures that we have included are client served, right? So depending on the role somebody has in a company, they may be somebody that just reviews the work. So they may not put in as many hours because they're just reviewing the job and signing off on it. They're probably not going to have as many hours, but if you measure based on how many clients they served, that number would look different than potentially just hours worked. How many referrals did that person make to the company? And this is something I encourage people to consider, where the ability for somebody to provide hours may be limited, such as maternity leave, disability, family medical leave, any life scenarios that challenge the ability to show up and do the most work. You can be on maternity leave, but you can still support your cooperative or paternity leave and still support your cooperative by sending referrals, right? Making connections, bringing in sales. If you are, a person that goes to retain the clients, go attract the clients, and someone else provides the service, you want to make sure that the people in the cooperative are being rewarded for the contributions, even if everyone's not doing the same thing, right? Everyone might not hold the same role and hours work may not be sufficient, but salespeople could be measured on volume of sales, referrals made, how many clients somebody served. Contributions to governance is another consideration, where if a person's role is primarily to be a secretary or an internal kind of developer, facilitator, and other people are serving clients, you may think about measuring hours worked and compare client hours to internal hours, or create a system where the more people that show up to membership meetings and planning meetings get a certain number of percentage points toward their profit share, because you want members to not only show up to do the work for clients and for customers, but you want them to show up and do the work for the company as well, because any cooperative has multiple people, multiple owners. Those are your teammates, right? So you want people to show up for the actual company. And like I said, we use profit as a reward for participation. So we want to encourage participation. We want to think about times where members can't just contribute hours, but they can provide value in other ways. And we want to, think about success as an organization outside of just working the most hours, right? Because work-life balance may not be in alignment with just working the most hours, right? So just think about ways that you can measure value in the company, other than just working the most amount of hours. And so, Maureen, should I mention the slides that are hidden but can be referred to? Yep. So we have another slide. We're not going to cover it on the webinar, but there are two slides, two more resources where we've provided examples where you can actually review what a patronage allocation may look like if you're using more than just hours worked, or you're using more than one patronage measure. So we're not going to go through this example in detail, but this is what it may look like if you have the same 5,000 of profit, it's 100% of the total is 5,000, and you decide to allocate profit using more than one metric rather than just hours worked. You can have client hours versus administrative hours. You could change the administrative hours to governance time, governance activities, who showed up to the meetings, who took minutes, who contributed to votes, who participated. You could change this model, this dual allocation model, to be hours worked plus volume generated, right? Which clients are bringing the most revenue, and the portion, your share of that portion. So we encourage you to consider measuring the value of a company in ways that represent your member base and your owner base and the type of business that you are, other than just the straightforward hours work, because we know that may not work well for every company, and that may not work well for every situation and every stage in a person's life as they're affiliated with the company. And so after this section, we had another pause for questions. Do we have any questions so far? Or?
Lucas wrote in the chat so many questions.
Oh, there's so many questions?
I'm going to read that one out loud. And then if you want to ask your question verbally, feel free, if you know how, to press react and raise your little yellow Zoom hand. And do we have a need from the interpretation team? No. Okay. So Lucas's question is, we are a year one cooperative corporation. Are we legally required to pay internal admin time by worker owners? Right now, we are just paying W-2 wages for billable client time and then creating a formula for patronage that combines hours worked and internal contributions. And then just to announce the stack before you answer, I'll pass it to Maria Lisa to speak her question verbally, then Emily, then Stephanie. But for now, we're going to answer Lucas.
Okay, so we're answering that question now? Okay, so the question was, if you are newly formed cooperative, are you required to pay worker owners for administrative time? So the best response there is it depends on the state. It depends on, different states have different rules about labor, right? Department of Labor federally has their rules, and then the different states have their different rules. Some states provide exemptions for key owners or key workers, such as officers, such as decision makers. You would have to look into what the exemptions are for labor payment in your state. And I do want to point out Parag, because I know that he's here he did just respond to that. And I was going to actually point him out because I saw they were here. That's one where I would say refer to an attorney, because that's not necessarily a tax question or a finance question. questions about pay and labor seem to fall more under legal questions. So I do want to point out Parag, they have a company, I don't know if they're a cooperative, they might be a cooperative, but he just responded in the chat. He could definitely help you answer those legal questions. But outside of that specific, referral, I would say check with the state statutes and check with any exemptions that exist about key workers or officer pay. And I know we said we were going to hand it off to someone else.
To Maria Lisa.
Yes, thank you, Marie. Thank you, Andrea. This is Maria Lisa from Massachusetts. My question is, we incorporated back in 2024, and I guess this question kind of goes in hand with what you just answered, but a little bit different. If the admin work has been done for one or two of the members, but we've not been able to compensate ourselves or the team members providing that service, is there a way to do some kind of like, I don't know if it's called built-in equity for already work that is already being done to be able to, I don't know, compensate ourselves for future membership fees or something like that? Is there any way? Because what we see here with the co-ops that we have is that some of the members are working additional hours than others, and that could potentially create some kind of resentment within members that we want to be able to avoid any kind of confrontation. So is there any way that it can be put in a financial statement or anyway, some kind of built equity or something like that for work that has been already done that we're not able to compensate members because we're only billing for what we doing with clients, as somebody else mentioned before. And I'm sorry if I'm going in circles. Hope made myself understood.
Yeah. So I think I understand your question. Is the biggest concern is that you have members carrying the administrative load that you're not able to compensate them right now, but they want to make sure that they are rewarded and eventually compensated for the extra effort that they're putting in on behalf of the organization?
That is correct.
Okay. So the first thing I would say, just to always think about like your bylaws and your governance, right? Every company that starts, you have your operating agreement or you have your bylaws. This is one of those considerations that people should think about when they're starting an organization and they have limited resources, to include policies and procedures around this topic. But here we are, if we didn't include those or have a plan for those. One of the things that I recommend to people, because I know new companies are often on a very shoestring budget, small budget, you don't always have the resources to pay people. If you have the exemptions from your state for key employees or owners, you're not required to pay an owner the way that you would pay a non-owner in some states. So my recommendation, if you're in that situation, is to accrue the time. If you don't already have something in your bylaws saying that, we allocate patronage by including administrative hours and early contributions, founders patronage, there's language you can include about that early time, and include it in your patronage calculation. But if you don't have that, what I always recommend is accrue the time, like show the time on your balance sheet as a payable. If you're a cash basis taxpayer, you're not going to be able to deduct the amounts that you accrue because it's based on only what you pay. If you're an accrual basis taxpayer, I would only recommend accruing it on the books as an actual accrual if you guys do intend to pay that person out when you get the funds. But because they did provide the time, they did the work, you may not have the funds to pay them now, but you could recognize by an official accrual, accounts payable or like labor payable to that person so that you can pay them when you get the funds, or track the time, and then maybe go after grants or go after, like, include it in your budget. Make sure to factor in the fact that this person did put that time in. Consider modifying the patronage policy to include that time, some other way to reward them through profit and not labor payments. But does that make sense? Like, accrue the
Yes.
time, pay it when you can, track the time.
Thank you. Thank you.
Yeah, for sure.
The next question is, I believe, from Emily. A question about the first part of the presentation. I thought 1099 NECs were for non-employee compensation. So are non-partners working for a partnership not considered employees?
So the question is, if you have a worker member who's not an owner, do they receive a 1099, or it sounds like a W-2? They are an employee, but they're not an owner. So earlier in the presentation, I made a mention of reporting payments to a non-owner on a 1099 NEC. But I do want to say that only applies if they're not an employee. So my comment before was intending for people who are not employees. If they are an employee and they receive wages, you have a payroll system set up, then you would report payments to them on their W-2. But not all cooperative corporations start with employees. Some of them are individuals contributing as self-employed. So to answer that question, if they are an employee, by all means, report it on the W-2. If you have non-owner members or provisional members who are also not employees, you would use the 1099, if that makes sense. So W-2 trumps. If they're an employee, you would report it on their W-2. But if you have people who are not on payroll, they're not W-2s, or they're not employees, you would report it on a 1099.
We got a thank you in the chat from Emily, so
Okay,
I think
awesome.
I'm going to move on to Barb, and then we have a question from Lily. So Barb's question is, will there be any discussion about state income taxes? We are an LCA based in Colorado, and we're having a very hard time registering in other states with remote workers, as those states do not recognize the LCA entity type at all and won't let us do a foreign registration.
So the question is whether we were going to cover state income taxes. We don't have a section specifically for states because there's so many of them and the rules are so different, but we reserve moments like this, like questions where we can address specifics. It sounds like the issue here, you're organized in Colorado, you have some members in Colorado, but you have remote workers in other states. When you say that you're running into challenges registering in those other states, are you saying that registration is for payroll, like setting up payroll systems and payroll reporting in other states? Because state taxes are more
No,
straightforward than that.
no, it's not for withholding. It's for setting up a foreign registration so we can pay the income tax. Sorry, I have the
Okay.
flu. That's why I sound so terrible.
I'm sure you're not alone. It's been going around.
Yeah.
Are you, by chance, are you referring to California state paying those income
No,
taxes? Okay.
no. Texas,
Okay.
Virginia, a lot of them.
Okay. So Texas specifically doesn't actually have an income tax for businesses or
Right.
individuals.
They have the franchise.
Franchise, yeah, you'll file the Are you having trouble filing the franchise tax
All
return
right. I will
or
skip
just setting
Texas.
up?
Maryland. I mean, it's been every state so far. Indiana,
Okay. Maybe what
Maryland.
we could do, I mean, since it's a bunch of states and it's an issue particular to your cooperative, we have a slide coming up soon where we'll talk about how I'm offering 1 hour free consultation to everybody on this call.
Hmm.
So feel free to set up a call with me. We have, if you click the link there, if you go to the URL, we could set up a 1 hour call to like dig into the specifics. We can do a screen share walkthrough, like what might be causing the problem, but I'm not sure if I can answer that with all the different states having almost no information about it, but I can certainly help you on a one-on-one if you want to schedule something with me.
That's okay. I just was wondering if you were gonna address it at all because I feel like this is sort of one of the things that no one spoke to us about when we were starting the process of being a co-op because
I
we
would
have
invite
so many.
Parag. Oh, I would invite Parag to respond if he wants to unmute himself. He's the attorney that's on the call, and he did respond in the chat. But he sounds like he has some information that could help you, or he wants clarification.
Okay.
No, thank you. I didn't mean to, I just get very active in the chat, but I did want to, this is a concern. I'm glad you raised it. There's no perfect container for cooperatives, as folks know, and there's no perfect container for worker-owned cooperatives in particular. And foreign registration, before we get to the tax registration, other registrations or business licenses within states, just the registration as a foreign entity, if the state doesn't recognize the entity, it becomes a real challenge. So I'm sorry that you weren't advised on that, but that's definitely something we let people know when they talk about LCAs or LWCAs or even general worker co-op or general cooperative associations. Is just if you anticipate that you're going to be working in different states. I think part of it is whether the state would recognize it as a foreign LLC. And I'm sure you all have gone through this, but I asked about Jason Weiner's firm in
Yeah.
Colorado. I'm sure you're aware of them. I'm not sure if they've
Yeah, they were too busy to take us at the time.
yeah.
So, we didn't, I know that he's the one who like did the whole statute in Colorado to begin with. So I know that they know a lot about it. I'm actually meeting with them tomorrow, believe it or not, because we've just had so much trouble. Like none of the states will recognize us. And so we might have to change our entity type.
Yeah, I'm sorry about
But
that. I think that it's a cautionary tale. I've been talking to some folks around, some of the entities that they're really useful in some ways, but they're also, the states just haven't caught up.
yeah, I wish we had known this before. We would have just been an LLC, with a 1120 tax form and been done with it.
Yeah, and the other thing, this would be a good time to mention, given that complexity she's run into with multiple states, the worker cooperative, the LCA, the limited worker cooperative statutes are becoming more common across the states, but they're not everywhere. So I would encourage, get your legislators involved. This is where like part of the movement piece of the cooperative and the resources that we pull together, the grassroots, we need to push for more states to recognize the cooperative entities. I know the state of Illinois didn't even have a cooperative statute until I want to say 2020 or 2021. So it is becoming more common, and states are recently creating statutes. But again, Washington State has 3 types of cooperatives on their books, 3 options. Illinois only has 1. Colorado most likely has more than 1. But this is where that like grassroots, local push, like politics are involved here. We should get more states to recognize and create what do they call it in accounting, reciprocity, like recognize reciprocity and recognize uniformity among some level of uniformity among the states for cooperatives. So
I wanted to plug, I've put 2 resources for those on the call to continue those specific conversations around HR, operational, or admin needs. We have an operations and HR peer network, and we'll also send out information about how to join it. But it's a free place that you can troubleshoot these questions for anyone in your cooperative who's responsible for holding the question of how to set up your operations, administration, human resources, finances, bookkeeping, personnel, employee benefits. It's a very useful peer network that has an active listserv. And then to speak to what Andrea just shared, we do also have for members of the Federation, since we're a member-led organization, a policy and advocacy council, which is a space where members come together to figure out worker-centered values that they want to push forward through legislation. So that's open to any Federation member. And if you're interested in becoming a member, I will add that link in the chat as well. And then I think we have time for one more question. So coming in at the buzzer, Lucas says, we have W-2 and 1099 non-owner workers in our cooperative corporation. Our owners are all W-2 employees. I understand that we can only allocate net profit as patronage that was generated by the owners, and that this is typically determined by dividing owner hours by total hours. If we're going this route, should we include all W-2 and 1099 hours in total hours worked within the co-op, or just W-2 employee hours? Maybe too niche a question.
Not too niche at all. That's actually exactly what patronage metrics, patronage calculation is all about. Specifically to answer that question, if you're using hours worked as your patronage metric, then I would include all hours worked within the company by owners and non-owners, because the non-owner portion, when you figure out what percentage is from non-owners, do not qualify as patronage, because patronage specifically is the allocation of profit to owners, and that amount can be deducted on the corporate return. So amounts that are profit generated by non-owners can't be deducted on the corporate return. So the first part of the question, I would say include all the hours, but even though you said you have non-owners contributing, and we're talking about sharing profit here, I want to, remind or encourage that you can still profit share with non-owners. You can still give them bonuses, performance-based payment, even as a 1099, but you just can't specifically treat it as patronage on the tax return. So what that means is if you have a profit in a certain year and you figure 50% of it came from non-owners, then you can deduct 50% as patronage on the return, pay tax on the other 50 at the corporate level. And then because we're in the following year now, if the year closed, you can still distribute to the non-owners profit share, bonuses, performance-based compensation. It just won't be deductible until the following year, like the following tax year. So there's like a timing difference there, but it doesn't exclude non-owners from share of profit. It's just applied differently. It's not technically patronage, but you can still do performance-based profit share or payments.
Lucas, did that answer?
Yeah, I guess the kind of specific question within that is for figuring out how much yeah, I think it's a good starting place. Just know some time. I'll keep on thinking about
iPhone, I want to hear your question, but out of respect for the interpretation team, we're not going to go over the half hour. So we may answer it in the slides that we send out after the call. But feel free to come off mute and ask your question.
Okay, hi. Yes, we have a new cooperative with, this is our first year. And so the question is with the patronage and taxes. I'm not really familiar with how that works. Like, is the profit going to be taxed if we don't distribute it before December 31st? And if there's any like guidance on best practices for when to do patronage distribution to make it better for the tax, the tax amount you're gonna get. Yeah, those basic, I don't know. Do you understand my question?
I think so. You're saying when it comes to patronage, do you have to distribute it by the end of the year? What resources can you use to understand that concept of I want to say that the Federation probably has resources on their website discussing the timelines, the 20% requirement, it was mentioned on the slide, but you actually have, if you're doing patronage, you have until September. That's that timeline that we talked about. You have until September to figure out what the patronage allocations are. Even if your deadline is April, if you don't qualify for that extended deadline, you can extend it in April and you still have some time to figure out what the patronage allocations are.
Right. Yeah, but this is for an LLC. Sorry, just to clarify.
Oh, for an LLC. No, so you don't have to distribute it by December, but you would, that time between the end of the year and when you file your return is when you figure out who it all gets allocated to. And then that's what you report on the returns
Okay,
when you
great.
file for 25.
Great. Thank you.
Oh, there she goes. There next week. So go ahead, Maureen. You can discuss that.
Yeah, I wanted to say thank you to everyone for attending this call and for being so attentive to the financial needs of your cooperative. I'm so impressed. And Andrea, thank you so much for presenting what can be stressful information so calmly and so thoughtfully. And Parag, thank you for jumping in as our unofficial legal consult on the call. I really appreciate the cooperation among service providers. I want to encourage all of you, if you're interested in working with her firm, when we send out the slides, you'll have access to the hour free consultation. Unfortunately, it's only available in English. So if you have questions in Spanish, Andrea, could you drop your email in the chat so they can send them to you? And then if there's a group of Spanish speakers who are interested in scheduling an interpreted time, that might be something we could facilitate through our member council, the Consejo Movimiento de Migrantes y Cooperativas, MEC. So bring that need to the Federation if it is a need. And just to reiterate what I said in the chat, if you're interested in getting involved in policy, our next meeting's on Thursday. If you are an LLC who has lingering questions, next week is all about the timeline for LLCs, and the presenter is Denny Breisler. And then if you're interested in organizing with other immigrant-led co-ops and you speak Spanish, again, this Thursday, we're having a member meeting about how to do a co-op fair for immigrant-owned co-ops. And I want to say, if you found this helpful, we'd love to get your evaluations. So I'm going to drop 2 links in the chat. One is to evaluate Andrea so that we can get any feedback about what you would want more or less content on, or just to tell her thank you for the incredible job she did today. And then one is for Tilde to give them feedback and appreciation for the quality interpretation I know they provided. So thank you all so much. And with that, we're going to end the call and end the recording, which we'll be sending out to you over email to the email that registered for the event. Thank you, everybody, for coming. And thank you, Andrea.
Maureen, are you going to stay on? Or are we still recording?
I just stopped the recordings. Yeah.
Okay.
It looks like someone might still be.
No, it's